let's move to equity then. Altaf, State Street custody data suggests renewed rotation into emerging market equities. What's driving this move? And do you see significant difference between retails or institutional investors? And more broadly, what role would emerging market play in global asset allocation in 2026? Are we really seeing a lasting return of capital flows to these economies?
Okay, so thank you very much, Thomas. So, by way of introduction, my name is Altaf Kassam. I head the investment strategy and research team in Europe for State Street Investment Management. So like Thomas said, we're an investment manager, but we sit inside State Street Bank. And so we have access to the custody data, and we can see on a broad level what investors are doing in equities, in fixed income across the board. And it's true that in equities, we've seen a return of capital to emerging markets. And I think there's a few reasons. One is that kind of post-Liberation Day, everyone was worried about the tariffs, trade war, what that would mean. But in the end, we haven't had a worst case scenario. And so the market has become relatively more relaxed, and we've seen flows into riskier asset classes. Clearly, we've seen that in equities across the board, but in emerging markets as well. Secondly, we expect more accommodative monetary policy from the US, and we also expect the dollar to keep weakening, and that's being mirrored by our clients. And again, those are good environments, not just for EM equities, but for EM fixed income as well. And then finally, I think the feeling is that global growth can continue to surprise on the upside. And above all, in equities, emerging markets are kind of levered to global growth. So as long as we don't get a worst case scenario in US versus China, we don't get, there are risks out there, geopolitical risk, obviously, between China and Taiwan. And I think when you invest in emerging market equities broadly, you can't ignore China. So I think, a lot of this rally came from China as well, but we have to keep an eye on China, keeps promising stimulus, not delivering. So I think for that rally to continue, like you said, and like for investors to keep allocating to emerging markets, we should see a bit more follow through from China on the policy side.
Okay, excellent. So, Mauro, let's try again. Let's come back to you. Let's try again. So, I was saying that 2025 was a volatile year. Yeah. And what lessons do you, this period left behind? If your approach to duration or risk management have evolved after this year?
Yeah, duration has been a performance killer since 2022. It has been beneficial this year. You have to distinguish when you manage, obviously, an emerging market bond portfolio in our currency, in dollar. In that case, you are exposed to the US dollar curve. I think there is still some value in the US dollar curve. It's also a very good edge. Normally, if something goes wrong, if we enter into a recession, you have whatever sort of crisis, that is a very good edge against the spread widening at sovereign credit risk level. So, I think we are in a situation in which value left on the credit spread is quite limited. Spread are at their lows. We still like to gain exposure to certain names in the credit in the corporate space, but there you have to keep, I think, lesson learned, a relatively short duration. You want to be ready to deploy your money, to get your money back and to deploy if there is any volatility. While on the interest rate side, obviously in US, the short, medium part of the curve is still offering some value. The market is pricing 3% interest rate within the end of 2026. It might be even lower if we have any sign of slowdown of economy. So given that, that's the position of your currency. Obviously, you have also local currency. Local currency, emerging market have been much better than developed market in managing fundamentals. So policymakers have been definitely more orthodox. Is a very diverse universe, so you have to be able to select it. But there you have a combination of countries where real rates are very high, Brazilian economy, Brazilian real. You have economy that with the central bank in developed markets on hold for longer, maybe even on an easing side, you can make money from the central bank willing to cut rates further. Mexico, if you are a brave heart, you can go in frontier markets. Or, you can play aggressive carry trade like Turkey that worked quite well this year. Is a very, very dangerous trade if you want, but the combination of stable central bank behavior, orthodox central bank behavior, a qualified Minister of Finance clearly benefited the investor that took their chance to invest in carry trade on local currency Turkish pound.
Yeah. Okay, excellent. So this leads to our next question. Kevin, are you? Your fund invests in frontier markets, such Angola, Kenya, etc. These are often challenging environments. How do you manage liquidity and also governance risks while still finding opportunities?
Yeah, great. Well, thank you very much. Just by way of an introduction, my name is Kevin Daly. I'm an investment manager on the emerging market debt team based in London for Aberdeen. We manage 22 billion in emerging market debt, of which 2 billion is in dedicated frontier strategies. Now, to the question, first of all, we've been doing, frontier for several decades now in the actual fund itself since 2013. So we have a lot of experience managing through these different sort of challenging periods, interest rate cycles, some credit events, and what have you. But I think what we are seeing now in frontier markets is you're still getting some very attractive yields. And in many cases, you're seeing some improving credit stories. So I use example of Angola. Angola is one of these countries that's actually doing all the right things, paying down its debt, paying down its, in particular to China. Debt GDP is now below 60%. And yet every time oil prices start to wobble, it's the highest beta oil credit in our universe. But from a debt sustainability standpoint, it's a good story. And, yields on dollar bonds are 10% plus, right? There is no local market in Angola, so you don't have to worry about that. But, in some of these other markets like Kenya, there's an attractive local currency market where you're getting yields of around 12 to 13%. So, for us, given our experience and performance of our strategies, it really is an attractive asset class. On this trip to Spain, I learned a new term, which is nicho, right? Which in our language, in English is niche, right? It is a niche asset class. There's only a handful of dedicated frontier funds out there. So, if it's an area that you haven't looked at, I'd encourage you to look into the more details, given the attractive return potential you can generate from a dedicated frontier strategy.
Okay. So turning back to equities.
Yep.
In your recent research, optimizing EM equity exposure, you compare passive, active, enhanced, and small cap strategies. Which approach do you think best capture today's opportunities? And how important will monetary policy divergence and dollar dynamics can be for emerging market performance over the next year?
Yeah, so thanks. So we wrote this paper, Optimizing Your EM Equity Portfolio. And like Thomas said, we tried to see how all the different ways that you can approach EM equity investing can work in a specific portfolio. Index, smart beta, quant, fundamental active, and so on. And I think right now, if you want to capture the growth potential in emerging markets, the interesting stories are all happening in the smaller companies. So, you've got the big companies, they've been around for years, a lot of state-owned enterprises, a lot of financials, a lot of big tech names. And, you're not getting something that's hugely different from what you can get in developed markets. But if you go the next level down and look at smaller names, particularly in China, you get a lot more breadth. So one thing that's hurting emerging market equity investing as much as it is in developed markets is the concentration that we're seeing. And it's the same phenomenon in emerging market equity. So when you go into the smaller names, get access to more breadth, you get access to the growth story that's in emerging markets, which has been disappointing in the last few years that it hasn't translated into equity market performance. And that's because a lot of investors just look at the large caps. When you move into the small caps, get access to those interesting stories, the demographics, the growing middle class, the increase of consumption, and so on. And so for us, that is the way that we would say, if you really want to get to emerging market growth, that's the way to do it.
Okay, excellent. Mauro, compared with developed market fixed income, where do you see the best risk-return balance within the emerging market debt space?
Yeah, in Plenisfer, we manage a total return strategy, so we are quite unconstrained. I think that you need to manage, I see an opportunity, as I mentioned, in selected local currency market with the different level of risk. I mentioned Mexico, Brazil, and also carry trade like Turkey or Egypt, names we can add to the frontier market universe. In that space, there are a pretty decent number of special situations. So stress company or situation in which you can really capitalize on a number of restructuring. It happened last year on airlines like Gold. So it's a quite articulated universe. If you deal with it from a total return point of view, I think you can find enough opportunity. Being a multi-strategy, clearly we look also at equity. I completely share the view. There is concentration also in the equity indices, but when you go below the surface, you find a reality that is very different. When I think of growth, the differential of growth between the growth of emerging market and developed economy, in particular U.S. economy, has been shrinking for years. Now we are entering a phase in which emerging market economies are growing at a faster pace than U.S. You can identify economies with a very limited debt burden in Southeast Asia. I think of Indonesia, India, and this economy growth in real terms at 5%, and they can grow at 5% for a prolonged period. China is a contrarian call, very interesting, I think. When you look at China, they have we have benefited from a strong performance of export-driven tech companies, the concentration we mentioned. I think you have to look also at the domestic universe. And in the domestic universe, there is an excess capex, but however, they are trying to address. The moment in which this excess capex will be reduced, profitability will improve, and there are demand trends that extend also to a number of LATAM countries that give us a pretty diversified universe when compared to developed markets.
Okay. Looking again across the frontier markets, the frontier universe. So you mentioned some of them, but which regions seem most promising right now? Maybe Egypt, as already said, is one of the biggest positions in your fund. Where do you see the best compelling opportunities?
In terms of regions, Africa is by far the largest and most liquid part of the frontier universe. And you have opportunity in hard currency and local currency bonds in many of these countries. So Egypt is a good example where, we were out of Egypt for a couple of years and then re-entered the local currency trade in March of 2024 after the big devaluation of the pound, which was part of the IMF program. They requested that Egypt allow the currency to be determined by market forces. So when we first started buying Egypt local, yields on T-bill, one-year T-bills were above 30%. Now they're down to about 24, 25%. And the currency has been, has modestly appreciated, which is a nice addition to our returns as well. Now, Nigeria is another example of a very interesting market. Again, we were out of Nigeria from early 2020 to March 2024, and then you had a big devaluation of the currency. Again, yields above 30%. Today, those yields in Nigeria are down to about 21%. But, what I like about Nigeria and Egypt is they're the largest and most liquid local markets in frontier. So you can trade in and out of them if you want to. But more importantly, you're getting very attractive yields, where if you were to buy, dollar bonds in Egypt, Nigeria, which we've held in the past, yields now are, say 10-year yields are closer to 8-9% in these countries. So that's still pretty attractive carry. But, when you look at the relative value between hard currency and local, it looks more attractive on the local side. So again, there's opportunities in dollar bonds in many of these countries, in local markets. And, it's all about diversifying your risk, of course, across 40 to 45 different countries. So, we feel, what also makes this area interesting too is it's really an underfollowed, underappreciated part of EM, right? There's only a handful of dedicated frontier funds. These countries don't get the widespread macro coverage by sell-side analysts. So we feel, we're experts in this area. And, again, given our experience, we feel that this is an area where we can add value for our investors.
Okay, and bringing up another aspect of this topic. So are frontier market becoming more predictable or becoming more mature? Or do they remain mostly opportunistic and idiosyncratic?
Historically, they have been very idiosyncratic markets. So, when you look at, again, fundamentals in a lot of these frontier countries, we are seeing signs of improvement, whether it's in fiscal deficits declining, debt levels declining, FX reserves improving, inflation coming down. So that makes the local markets more predictable, right? And you don't have, because there is no frontier local currency index or universe, it's an off-benchmark investment for many investors. So we like that, the technicals in these local markets. But in terms of the other, broader range of frontier, I think there is, when you look at other indicators, whether it be sovereign ratings, you're seeing a number of upgrades now for these countries. So we've gone through a credit cycle where we had a number of defaults over the last 3-4 years. And now we're sort of in a environment where the narrative is shifting from restructuring stories into performing countries. So yeah, I think this is not to say we could have another period of credit events, but just to put you at ease, I think in your typical global high yield strategy, you're going to have a number of companies defaulting. It's part of the universe. But when you look at frontier, yes, there have been some credit events. The question of whether your manager has been able to avoid those events, and that's also part of the predictability. If you've got experience in this asset class, you can tell from there is a signals out there that you can look at that should give you a good steer on which countries to avoid, because there's plenty of high yield opportunities in sustainable performing countries out there.
Okay, so Mauro, given the uncertain scenario that we have, and with a lot of political volatility, etc., how much tactical flexibility do you think a portfolio needs to navigate today this emerging market debt and also equities?
I think as a minimum you need an high conviction investment approach in order to qualify your position in a way in which they can contribute positively. The level of volatility, the different monetary policies, as we mentioned before, emerging markets are a very heterogeneous universe. I think you need to be as much as possible unconstrained. We choose to be fully unconstrained to take advantage of this type of situation, and that allows you to focus on and trying to identify what you mentioned before, as much as possible idiosyncratic investment cases, but minimize your risk. To give you an example, sometimes you find that from a fundamental point of view, quite difficult economies. Think of Argentina. It's recovering now, but it's been not exactly a nice place to invest in. A number of defaults. But in these countries, for example, there are corporates that have been operating, have been working for ages without defaulting. They are needed. You need a telecom company. You need a utility. You need a power company. So that country offer a number of excellent investment opportunities if you knew well that environment. They were just a decent company in a bad postcode, in a bad geography, and they offer crazy carry. 4 or 5 years ago, these were idiosyncratic opportunities. So pay you 20% was large enough to compensate for the volatility you can have in price. When they trade at 7% as of today, they are directly exposed 1-to-1 to what can happen to this country. So the ability to be unconstrained, to identify opportunities in the different sub-asset classes of emerging market is critical to survive.
Okay. really good point. Altaf, yes, from an asset allocation point of view, do you see emerging market more as a tactical play, or should they be a structural component of long-term portfolios?
Yeah. So you mentioned before that people have been using emerging markets for years for growth and diversification. And the diversification issue is the tricky one, because as happens over time, emerging markets mature, the companies mature, and they get more plugged into developed market business cycles. So if you look at South Korean equities, you've got Samsung, Hynix, in Taiwan, the biggest stock by far, which is almost 2/3 of the market, is TSMC. These are global companies. They're not really plugged into emerging market growth. So once again, if you really want that diversification, and that's what you need if you want it to be a strategic part of your portfolio, you have to look at the smaller names, the more interesting names, the different countries. And like Mauro said, I think it makes sense now, whereas before we could kind of count on China, own emerging market equities as a block. Now we need to be a bit more differentiated and think of it more heterogeneously. Some markets you invest in tactically and actively, some markets are more structural. But for that diversification that you need for it to be part of a strategic asset allocation, you need to look at the smaller names and get access to the real kind of emerging market growth story that's there. Tactical always makes sense. Like Kevin said, try and avoid the landmines. Like Mauro said, have high conviction, and you can do that around the edges, and ETFs have really helped with that. But generally, for a strategic investment, I think you need to think much more broadly about emerging markets than just the MSCI equity index.
Okay, and may I ask how Forex is impact in your portfolios, and how do you manage Forex in emerging markets? Do you prefer to hedge it? Do you prefer to use it as a tactical opportunity?
So far, we've been mostly using it as a tactical opportunity, but we're getting more and more demand to hedge it. So the question is, what do we think is going to happen with the dollar? We still think there's weakness in the dollar in the medium term. So maybe you can let those currencies ride, and we still think there's value in the currencies, but it becomes something that you really need to monitor. And if you have the resources and the governance to do that, then by all means, I would use it as a tactical opportunity. Otherwise, we see investors being a bit more cautious and hedging a lot more these days.
Okay, Mauro, can I extend this question to you? How do you manage Forex?
I follow the same approach. I mean, when you look at local currency are quite volatile. Obviously, the exercise you have to do is to assess the fundamentals, and the fundamentals have been pretty well managed. You need to check the external vulnerability this country is exposed to. That's why Turkey is a risky position. I mean, their external vulnerability is pretty high, running current account deficit in the past wide. It's the same situation we have in US, but US has been able to fund this current account deficit thanks to portfolio inflows, constant portfolio inflows. So you have this kind of analytical stuff that you have to do. And obviously, you have also to be in the right macro conundrum. So the momentum has to be on your side. The carry has to be wide enough. In the end, you need stability to play the carry trade. Otherwise, the hard currency emerging market bonds offer, I think, one of the best, if not the best, Sharpe ratio when you invest properly. And that's avoid you, obviously, the vagaries of high currency volatility.
Okay, and Kevin, I want to extend this question also to you about how do you manage Forex. Also, in just a few words, in a minute, if you can wrap up in a few sentences, what could be the key catalyst that makes 2026 a real turning point for emerging markets?
Okay, so to the first question, how do we manage Forex risk? Pretty simple. We don't hedge FX risk because if you do that in Frontier, you're going to be paying away all your yield. And given that, I'd say on average, yields on our Frontier local currency positions are probably average sort of 16, 17% carry. That's a pretty attractive level, and it offsets the potential for some FX weakness. Now, we're in an environment where we're actually seeing FX strength, so that's actually enhancing the returns on our bonds. So yeah, I think it's when we do our return expectations, we always factor in some FX weakness, but then it's then offset by the much higher carry on frontier local than you get in mainstream EM local. In terms of 2026, when I think about what the environment could look like, I think it's probably expected that the next Fed chair will be more dovish than Powell, Jerome Powell, and that chair is viewed as being co-opted by Trump, and that can lead to not just more dollar weakness, but potential more Fed rate cuts. So you get a bear steepening in the U.S. yield curve. This is going to play right into the benefit of emerging market debt, and in particular frontier, getting higher yields. But yeah, I think let's say a scenario where the new Fed chair is not as dovish expected, the Fed is still going to be cutting rates next year, and again, that could lead to some soft dollar softness. And historically, weaker dollar has been very good for emerging market debt, as we're seeing in 2025. So I think, the outlook next year, probably going to see softer global growth from the impact from tariffs starting to hit. So again, that to me is the backdrop for fixed income. And lastly, again, historically, environments where the Fed cutting interest rates is very good for EM high yield. So, all this, again, this scenario to me is very supportive for frontier markets.
Okay. Same question to you, Alta. What do you think they are the key catalysts that makes 2026 a real turning point for emerging markets in 30 seconds?
So, everything that Kevin said about accommodative monetary policy and a weaker dollar, but in equities, even though I said it's heterogeneous, you have to look at countries individually, China is still really important. It has really importance for Southeast Asia. So we would need to see some form of measurable stimulus from the Chinese authorities to really take emerging market equities to the next level.
Okay. And Mauro, what do you think?
I think in the short term, you need stability. Central bank on the easing side are going to facilitate the performance of emerging market. In the medium term, I think that strategically a number of these countries will benefit from such a superior growth that will be translated in particular in equity market in positive performance.
Okay, so thank you, Mauro, staff, Kevin, for your insightful views. Thank you to the audience for joining us in the discussion. Thank you.
Thank you.